all Fitch-rated RMBS transactions that have been issued post-crisis have been issued with a strong rep and warranty framework. All of these transactions have been done out of the Sequoia program, and we believe that the provisions in that program are largely in line with industry best practices, including the ASF model reps. As we see new issuers look to tap into the new issue RMBS market, we are starting to see some proposals that introduce what we believe are incremental risks. Some of the provisions that have us concerned include things like missing reps or reps with qualifiers, particularly as it relates to fraud, breach definitions with conditionality. And lastly, we're starting to see sunsets. So sunsets related to underwriting guidelines, related to fraud. We believe that transactions with these more aggressive rep and warranty provisions or frameworks do have the potential to weaken a transaction and effectively reduce investor protection. We believe that the rep and warranty risk, or I guess what's most commonly known as put-back risk associated with these new issue post-crisis transactions, is actually pretty low. With that said, we do think that if some of these provisions are implemented or incorporated into transactions, we believe that they do weaken the structure and they expose investors to greater expenses and potentially higher losses. We also think that this risk has the potential to grow over time, particularly if credit standards begin to expand and the percentage of third-party diligence begins to decline. We're looking at these transactions on a case-by-case basis, and not only are we looking to try to assess the incremental risk introduced to the deals through a more aggressive rep and warranty framework, but also take into account some mitigating factors that allow us to help quantify that risk. So things like the quality of the pool itself, as well as the third-party diligence results. In the end, I think what you're likely to see from Fitch is when we see a transaction that has a significantly weaker rep and warranty framework, we're going to try to account for that incremental risk in the form of higher expected losses and higher credit enhancement. However, in cases that we believe that we can't quantify that risk, be it as a result of the collateral attributes or the rep and warranty provisions themselves, I think you'll see a different approach. And some of the things that we can consider in those cases include either assigning a rating cap or actually declining to rate the transaction altogether.